Запись включив.
Дякую, дуже дякую. Good day, dear Tusif. I'm glad to see you. Thank you so much for your sharing on our session. Could you please turn your microphone?
Yeah, apologies. Thank you very much, Vitali. I hope you're doing well, and it's good to see you again. Thank you very much
Thanks a
for
lot.
giving me this opportunity.
We can start your session, Chair. So you can start when you decide.
Yes, we can start. We are good to go with the session.
Thank you.
We have the first presentation.
Hi everyone, should I start presentation?
Yes, please.
Okay. 1 second, I will share a screen. Okay, I'm starting. Dear chairs, dear participant of the conference, my name is Alexey Ivanov. Let me introduce the research data analysis for predicting stock prices using financial indicators based on business reports by Alexey Ivanov and Vitaly Kobets from Kherson State University. I'm very glad to take the part in this event. On this slide, you can see the outline of our research. So, increased access to the stock market leads to growing interest in investing and increase in new investors. However, investing in the stock market involves risk and requires good preparation and analysis. New data analysis methods allow us to identify dependencies between financial indicators from annual and quarter reports and stock prices. Our paper aims to develop a model for predicting financial indicators from company business reports based on data analysis and machine learning using Python programming language. Our research tasks are overview of financial indicators that can be obtained from business reports, develop code for analyzing these indicators, and estimate obtained results. In financial data analysis and financial indicators forecasting, numerous studies have been conducted. We considered some of them, namely, in the article Forecasting Financial Market Using Deep Learning presented in 2019 by Zheng, investigating the application of deep neural networks for financial market forecasting. They used the stock index with exchange rate data and demonstrated that deep neural networks allow for high accuracy in forecasting. In the article Machine Learning for Financial Forecasting, Planning and Analysis, Recent Development and Pitfalls, presented by Wes Bacher, explored the application of machine learning methods for analyzing and predicting financial data. Their research used company stock data and showed the machine learning methods could be effectively used for financial indicator forecasting financial data. Their research used company stock data and showed the machine learning methods could be effectively used for financial indicator forecasting. In our article, we are trying to find dependencies between financial ratios taken from the report and share market price. The 10K report is an annual and quarterly filing submitted by publicly traded companies to the US Securities and Exchange Commission. It comprehensively overviews a company's financial health, operations, and risks. 10K filings are public information and readily available through several sources. Most companies include them in the investor relations section on their website. The financial statement includes three essential sections: income statement, balance sheet, and cash flow. The income statement summarizes a company's revenue and expense over a specific period, showing whether it made a profit or incurred a loss. The balance sheet provides a snapshot of company's financial position at a given moment, detailing its assets, liabilities, and shareholders' equity. The cash flow statement tracks how cash flows in and out of company, categorizing it into operating, investing, and financial activities to assess its cash management and liquidity. The income statement displays a company's financial performance during a specific period. It begins with revenue, representing the total income generated from selling goods or services. From revenue, the statement deducts the cost of goods sold, representing the direct costs associated with producing those goods or services, to calculate gross profit. After deducting operating expense, including salaries, rent, and marketing, from gross profit, the statement arrives at operating income. Interest and other financial expenses are subtracted from operating income to determine income before income tax. After accounting for income tax, the final result is net income, which reflects the company's profit or loss for the period. The balance sheet provides a snapshot of a company financial position. It has three main sections: assets, what the company owns or controls, including current, liquid, and non-current long-term assets. Liabilities, the company's obligations and debts, including current and non-current liabilities. And equity, the ownership stake of shareholders, including common stock, retained earnings, and other comprehensive income. The equation assets equal to liabilities plus equity always hold true on the balance sheet. The cash flow statement summarizes how company generates and uses cash during a specific period. It consists of three sections: operating cash flow related to the core business operations, including cash from sales and payments to suppliers and employees; investing cash flows from buying or selling assets such as property or investment; financing cash flow from borrowing, repaying debt, or issuing and buying back stock. The net result of this section shows the change in cash and cash equivalents for the period, reflecting the company's cash management and liquidity. From sections mentioned previously, we can obtain financial ratios, key metrics that provide insight into company's financial performance and position, which typically falling into four categories. Profitability ratios. These ratios assess a company's abilities to generate profits. Gross margin measures the percentage of profit a company earns on its sales after accounting for the cost of goods sold. Operating margin evaluates the proportion of operating profit relative to total revenue. Net profit margin calculates the percentage of net income in relation to total revenue. Earnings per share indicates the portion of profit attributed to each outstanding shares of common stock. Liquidity and solvency ratios. These ratios gauge a company's ability to meet short-term obligations and its long-term financial stability. Includes current ratio. Compares current assets to current liabilities, including a company's short-term liquidity. Debt to equity ratio measures the proportion of debt relative to equity, assessing solvency and financial leverage. Efficiency ratio. These ratios analyze how efficiently a company manages its resources and assets. Return on assets evaluates how effectively a company uses its assets to generate profits. Return on equity measures the return of shareholders' equity, reflecting overall profitability. And last category, valuation ratios. These ratios assess a company stock market valuation. Includes two ratios: price to earning ratio. It compares the stock current prices to its earning per share, indicating the market's perception of future growth. And price to book ratio compares the stock market prices to its book values per share, reflecting the company assets value in relation to its market value. We obtained historical data of quarterly financial statements from 1997 to 2022 for Amazon Incorporated. We obtained it in JSON format from a resource called Financial Modeling. Also, on the picture on the slide, you can see historical data of market price per share of this company. Our approach involves utilizing two distinct data analysis techniques, allowing us to compare the results derived from these algorithms. We have harnessed the power of multiple linear regression, a statistical method tailored for modeling relationship between a dependent variable and two or more independent variables. We have also incorporated random forest, a versatile machine learning algorithm that tackles classification and regression tasks. These assembled techniques construct numerous decision trees during training, pooling their predictions to enhance accuracy and robustness. We check it for multicollinearity before using multiple linear regression to analyze the relationship between stock prices and various variables. Multicollinearity is when independent variables in a regression analysis are high correlated, making it challenging to interpret and trust the model's result. As shown in the picture, we calculated the correlation coefficient between the independent variables to remove correlated variables. Then we set a correlation threshold 0.28 and removed highly correlated variables. In the result, it's left only 5 independent variables: net income, price to earning ratio, total equity, operation margin, and gross margin. Our independent variables show linear and non-linear relations to the market price per share. The graph shows the polynomial dependency between market price per share and gross margin implies a non-linear relationship. It can be said that multiple linear regression will not show good result, as dependencies between our variables and are not linear. We split the original dataset into a training and testing subset to train and evaluate the model's performance. We followed a commonly used approach where the data was split in 80-20 ratio, where 80% of the data was used for training the model and the remaining 20% was used for evaluating its performance. It helped us estimate the accuracy and robustness of the model on new data and prevent overfitting. We used the scikit-learn library for Python. As we can see on the slide, the code includes the following section: reading and built-in data frames from files prepared by script, dividing data into two sets for training and evaluation of performance, building linear regression and random forest models, obtaining key factors for these models in comparable table. We used RMCE, deviation percentage, and R-squared to compare our models. RMSE measure accuracy, deviation percentage measures relative error, and R-squared measures how well the model fits the data. Together, these metrics provide a comprehensive assessment of the model performance because they are interruptible, evaluated thoroughly, and capture different aspects of prediction accuracy and model fit. Based on the evaluation results, the random forest model predicts stock prices using financial indicators better than the linear regression model. The random forest model has a lower RMSE and deviation percentage, which means it has better predicting accuracy and fewer prediction errors. Additionally, the random forest model has a higher R-squared, indicating a better overall explanatory power in capturing the variability in stock prices. Total equity, gross margin, operating margin, price to earning ratio, and net income affect the market price per share. Considering the comparison of the two models, Random Forest exhibited superior performance in predicting stock prices compared to multiple linear regression. It achieved significantly lower values for both RMSE and deviation percentage, indicating the improved accuracy and reduced predicting errors. This indicates a non-linear dependency in our data. The deviation percentage of 43.61% may seem relatively high, suggesting that there is still room for improvement in the model precision in predicting stock prices accurately. While random forest outperformed multiple linear regression, it's essential to consider other factors that might affect stock prices beyond the selected financial indicators. Thank you for your attention. I will be glad to answer your questions. You can also reach us by email with any related questions.
Thank you very much. I have actually placed a question, and this was a wonderful presentation. I actually have placed a question related to the multicollinearity test. I mean, when we are running multiple regression model here, we usually go for testing the multicollinearity in the variables so that we ensure that these variables are not having any kind of similarity or relationship with each other, because that may somehow distort the results. So I just wanted to know that did we, did you test for VIF, uh, what we call it, uh, uh, the variance inflation factor VIF, while running this multi regression test analysis?
Oh, we already checking our independent variables for multicollinearity, and we removed variables which have a high correlation coefficient,
Okay.
if I correctly understand your question.
We have one more question in chat box. If it's possible, I can you can consider it.
Okay, I see one question from Alexander Novak. The question is, what do you think are the main factors influencing the prices of company shares? So, main factors which influencing the price of company shares, as I mentioned, it's of course performance of this company, what they are earning, how much money they are earning, and I guess, as I also mentioned it in the work, it's more factors affect the market price per share, because, for example, social networks, and if this company, for example, works in some bad area, like, I don't know, maybe some bad for our earth or something like that, or for health of people, it also can affect this company, because people will not consider this company. And also, I guess, company shares can be affected by whole market. I mean, if currently market state is bad, even if company performs good, it will anyway can be affected by overall market state. I hope I answered your question.
Could I also ask a question?
Of course.
Oh, thank you. Uh, so, Alexei, tell please, what do you think about statistically significant factors affecting stock prices? They will be common or different for different financial instruments or not? And why? What do you think?
I guess they will be different because we built this model only for one company, and it's probably not showing good results for one company. It's need to test on more companies to see results of other stock prices, and I guess it can be showing different results. And I guess for different companies, it can be even different variables which will be affecting this market price shares.
Thank you. And I have one more question. Could you please to explain how can we use these factors to predict stock price and how this information affecting investor behavior, for example? What do you think?
So if like we can predict not like to know exact price which will be in future, but we can, based on the report which we get from company 10K report, we can say how this company will be performing in future, and we can see if this our indicator showing that it will be bad performance, it means that market price per share accordingly will go down probably.
Thank you. Thank you so much.
Yes, please.
Alexei, yeah, thank you for your presentation. I have a little question. Did you perform some feature selection methods to define which indicators actually are the most influential for the prognostic power of your models?
No, I didn't. I get, if I correctly understand your question, no, I didn't try.
Okay, understood. Thanks. Thanks.
Dear Tusif, what do you plan to do now? Do you have any other questions, or we can continue? I think Tusif needs sometimes, maybe for some reason, call or something else. Thank you.
Yeah, Vitaly, if I may, I can actually start my presentation since my presentation is going to be next after Alexei.
I think if to see if let us continue, we can do it, but maybe.
I'm so sorry. There was a power failure at my end, and I had to connect with my mobile phone. I'm so sorry. We are still facing some sort of power failure and energy crisis in this country. So we have unannounced load shedding problem. Sorry for this, but I'm online and I am listening to you. Thank you.
Thank you. We close our questions. If you have any other questions, so you as a session chair can decide what we want to do or continue, or maybe you have new questions to Alexei.
Yes, I have some sort of comments for this research paper actually. When we are conducting a formal research, we try to make it somehow scientific. I mean, by scientific, we mean that we properly develop the research questions first, then we go for the hypothesis because the purpose of research questions is, sorry, hypothesis is to address or answer all those research questions. I mean, what I did not see here in this paper is the research questions, properly developed research questions, and then hypothesis development. I mean, the research is more clear that why you are commencing or conducting this research when you are developing scientific hypothesis, because what you are testing for are the answers to your research questions actually. So, was there any sort of research questions or hypothesis developed? Likewise, you are using multiple variables in this research. So, if you're using, for example, eight variables in this multiple regression analysis, there must be some sort of eight hypotheses developed. So, did we share or did we see actually the hypothesis of these? Uh, this article presentation here.
Uh, s- Sorry if I correctly understand your question. Uh, you mean that, okay, I guess no, we didn't share a hypothesis in this article, in the start of, in the
Okay,
beginning.
the idea is for a scientific research that could be presented on any international platform or for a peer-reviewed journal, we need to develop the research questions very clearly, and we also need to develop the hypothesis because you actually or we actually as a researcher run these testing models. Even if we are using smart TLS, we are using these multiple regression analysis, we have to test for the hypothesis and then come up with the results so that they can be presented on international forums, they can be published in peer-reviewed journals. So for coming, I mean, this is just a comment or a suggestion, a humble suggestion that for coming papers, please do include the research questions, well-established research questions that why exactly you are commencing or conducting this research. And then there are
Okay,
hypotheses connected. I mean, these are the assumptions connected with these research questions. Only then this multiple regression model can work scientifically. Otherwise, the results, yes, for sure, the results may be, predicting some sort of variable, but the results may not be accurate when it comes to generalization of these results. I mean, if you're applying it somewhere else, the results may not be the same actually, because the scientific method was some sort of distorted.
okay, okay, thank you.
All right. Yes, Vitali, you can proceed.
Thank you so much, dear Tusif. Thank you so much for your feedback. It's very important for us, and we will take it into account for our future work. It's also important, and it's our first. Preparation of our first steps in scientific direction, and Alexei proposed it a very interesting new approach with financial reports, and I think it will be very important to take into account about all what you told, and it will we will include it in our next research. Thank you so much.
Thank you very much. Thank you.
Can we continue to go to our next paper?
Yes, we can. We may.
Okay, so I will translate my screen. Just a second. Uh, Dear colleagues, do you see my screen right now?
Yeah.
Yes, receive.
Okay, just a second. Apologize. Place white. Okay, so good afternoon or good evening, dear participants of this conference. My name is Andrei Belinsky. I am an assistant of the Department of Economics and Digital Business of the State University of Economics and Technology, and also I am a PhD student at Kiev National Economic University, named after Vadim Hetman. So today, my colleagues and I would like to present you our study, which is titled as stock market crashes as phase transitions. So in general, when we study complex systems of different nature and complexity, we definitely have to consider them from different angles, using different models. So through the prism of different paradigms. We studied in our previous studies informational and recurrence measures of complexity theory. As an example, information theory is based on Claude Shannon's classical information entropy, which for quite a long time has contributed to the emergence of new information entropy, such as permutation entropy, recurrence entropy, spectral entropy, approximation entropy, and many others. The essence of all these measures is that they allow you to determine the amount of expected information, the amount of unpredictability or predictability in the studied signal. So again, they allow us to quantify how predictable or chaotic the system under study appears to be. The recurrence analysis is based on the repeatability of the studied trajectories of the system. Various systems exhibit either completely unpredictable behavior or rather deterministic. Uh, it's obvious that many complex systems, in particular financial crashes, demonstrate time irreversibility. That is, they evolve in the same direction over time. They can both develop over time and degrade, but they do not return to the state in which they were originally. Many social systems demonstrate a certain asymmetry. For example, asymmetry can be observed in the dynamics of the stock market or the wealth of the population. We have appropriate measures that represent the possibility of measuring that irreversibility or asymmetry of fluctuations in the signal under study. I would like to note that the collective dynamics of many systems can also be studied in the context of quantum mechanics using uh, the random metric theory, which makes it possible to distinguish deterministic processes from completely random ones. So, in the context of today's presentation, we would like to introduce you and perhaps discuss the multifractal measures of complexity. On this slide, you can also see some measures from graph theory, which includes various methods for studying complex systems. There are quite a lot of them. This includes various methods of representing signals in the form of graph, and on the basis of this representation, it's possible actually to obtain various graphodynamical indicators that we have. The story is the same with multifractal analysis. We have different ways to obtain fractal indicators of the system, but for this presentation, we took a multifractal determinant fluctuation analysis as one of the most reliable methods for assessing the complexity and fractality of the system. As already noted, the presented measures and many others from our toolkit are already implemented. And of course, we have plans to implement new measures within various paradigms. Our methods are implemented using the Python and MATLAB programming languages. And here, for example, you can see a link with the corresponding codes for all calculations. If to speak about financial crashes are economic disasters with far-reaching consequences. The idea here that we would like to present, we would like to construct indicators or indicators precursors for these crash phenomena. And the construction of indicators precursors is crucial because it helps us prevent domino effect. It helps us to protect livelihoods of people. It helps us to identify global interconnectedness. It helps us to reduce economic costs. So in summary, the construction of indicators precursors of financial crisis is essential for preventing economic turmoil, for promoting international stability, and minimizing the economic costs. In the following, we present phase transition indicators based on the multifractal approach. Phase transitions, in this case, are associated with some crisis events. we have chosen 4 key stock market crashes represented by the S&P 500 index as the subject of our research. So here we study Wall Street crash of 1929, Black Monday crash of 1987. Also, we study financial crash of 2008 and crash related to COVID pandemic. All further calculations are based on the financial returns of each of the presented segments. Each returns, as you can see, are highlighted by a red color in all figures. Now we would like to introduce the paradigm of multifractality. So in general, many complex systems and in particular stock market signals from a wide range of financial signals possess scale invariant structure. A stock index signal has a scale invariant structure with a when structure repeats itself on sub-intervals of the signal. Most commonly, the more monofractal structure of financial signals are defined by a single power law exponent, and it assumes that the scale invariance is independent on time and space. However, when we speak about spatial and temporal variations in scale invariant structure, it often actually appears. For financial signals, we often see some spatial and temporal correlations. And these spatial and temporal variations indicate a multifractal structure of the financial signal that is defined by a multifractal spectrum of power law, or in other words, of fractal exponents. In our analysis, when we speak about monofractal and multifractal measures, we consider some time series. These time series can reflect to fluctuations of stock market, of forex market, or even crypto market. And obviously, they all have different complexity. They have all different amplitude of fluctuations. They have also various singularities. And some of them similar to white noise. Some of them represent mostly monofractal dynamics, but the most complex are presented to be multifractal. So in this slide, you can see series multifractal, monofractal, and white noise. And they actually here are highlighted by blue colors. According to multifractal procedure, we need to convert the noises, these blue traces, to random walks that are highlighted by these red traces. And as you can see, actually, when we convert our noisy time series into random walk, here appears some self-similarity in these red traces. So this is indicator that actually the studied signal is presented to be multifractal. And multifractality in this case is associated with some spatial temporal correlations. Next, when we speak about multifractal detrended fluctuation analysis, we need to delete some slow varying trends. So we need to make our signal more stationary, to make it analyzable, to make it predictable actually. So again, slow varying trends are presented in financial systems. We can try to approximate these trends by different polynomials of first order, second order, or third order. And then we make the trending of the signal, and then we quantify the scale invariant structure of the variation around these trends. So next, we would like to measure the degree of deviations in our signal. We would like to know how scale invariant under different scales is presented our fluctuations. The structure of the monofractal and multifractal time series are different. Multifractal time series have lot of fluctuations with both extreme, small, and large magnitudes. That is absent in the monofractal time series. The absence of fluctuations with extreme large and small magnitudes result into normal Gaussian distribution for exactly monofractal time series, where the variation is described by the second order statistical moment. In other words, it's described by variance. But when we speak about multifractal time series, that is highlighted by these blue traces. So when we speak about multifractal time series, we understand that actually our financial indices are not normally distributed, And in this case, we need all Q order statistical moments that have to be considered in this case. Not only second order statistics, but also a third order, fourth order, and so on. Next, as it was said, if our system, our fluctuations are presented to be scale invariant and result into monofractal or multifractal structure, then we get such power law relation. Fq of S is the fluctuation function under different Q values and different time scales. And H, in our case, is power law exponent that sometimes is called as generalized Hartz exponent or singularity exponent. And we can derive this singularity exponent from the regression lines of our fluctuation function versus different time segments in this logarithmic scale. And here for multifractal time series, different regressions line are Q dependent, since we see that they go under different angles. And both the monofractal and white noise time series have no periods with small and large fluctuations, and consequently, their fluctuation functions represent the same angles over various time scales, as you can see. So for the time series of different complexity, we expect different values of singularity exponent. Singularity exponent less than 1 represent more apparent fast evolving fluctuations. Singularity exponent which is presented to be greater than 1 represent more apparent slow evolving fluctuations, more long-term dependence between studied fluctuations. And actually, relying on generalized Hartz exponent, we can derive different measures of multifractality. That is, in the following reference, will proclaim to be an analog of physical free energy and heat capacity. So actually, our statistical quantities, they represent some physical quantities in this case. And we can use these physical quantities of free energy and heat capacity to quantify how predictable or unpredictable is presented to be the studied financial index. So since most in the following, so as you can see, in the following reference, it was proclaimed that the corresponding multifractal heat capacity can be used for identifying phase transitions under different statistical Q moments. So you can quantify actually returns with lag 1, lag 30, lag 60, lag 80, and so on. And using this heat capacity, you can quantify which fluctuations are presented to be more dominant, small fluctuations or large fluctuations, which fluctuations actually are presented to be more correlated, more predictable in this case. So since most complex systems are multifractal, they can express different singularity exponents, and for time series with different singularities, we can derive different fractal exponents f of alpha. We plot a set of singularity exponents versus corresponding fractal dimensions, and we get the multifractal spectrum of the studied system. The wider it is, the more complex is the studied time series, the more heterogeneous its structure. And regarding multifractal spectrum, we can derive different multifractal measures, such as width of multifractality, height, its asymmetry, maximum and minimal singularity exponents, and so on. For our presentation, we will use only heat capacity. According to our studies, different studies, complexity of predominant amount of different systems changes over time, and we cannot characterize and make further analysis for the whole time series at once. The most adequate representation of the variety of complexity in the studied time series is the sliding window procedure. So the idea here is that instead of calculating some complexity measures for the whole time series, you quantify it for a sub-series. So you take this sub-series, you save your results, then you shift your window, again you repeat your calculation, your calculations, and again until the time series will be exhausted. And then you can compare actually saved results from some complexity measure and actually your stock index that you measure, or maybe crypto index, or maybe Forex index. So in this slide, we can see the power law dependence of each f of q. And as you can see, actually each of these lines is characterized by different angles. And it means in this case that our time series is presented to be very complex, very multifractal, and actually very correlated. So the studied crashes are presented to be very self-organized. Also, we can see other multifractal measures. We can see multifractal spectrum, we can see heat capacity, but in general, they all represent that the studied time series, the studied financial crashes are presented to be very complex, very self-organized, very correlated, and we can see that there is some phase transition at very large fluctuations, exactly at the stage of corresponding crash that we study. This slide illustrates that during a crash event, the total multifractal specific heat begins to increase, which indicates an increase in the complexity of the system during this particular period, an increase in the nonlinearity and width of the multifractal spectrum. As already indicated, during crash, the spectrum not only expands, but also acquires left-sided asymmetry, as you can see here. So when we see this left-sided asymmetry, we expect that our stock index is predominated by large fluctuations. And also from this slide, you can see the multifractal specific heat at the moment of the collapse event, which characterizes each of the crises as quasi-phase transition. With respect to various statistical Q moments, it can be seen that the specific heat looks symmetrical, but it's most important to note that during the collapse, it goes towards positive Q values, which indicates the predomination of large fluctuations in the multifractal nature of each collapse. And actually, we can see that this specific heat capacity can be used as indicator or even indicator precursor of possible crash phenomena in the studied S&P 500 index. And in conclusion, so we investigated the multifractality of the stock market using the example of the S&P 500 index and its four main crash events. The crash of 1929, the crash of 1987, the crash of 2008, and the coronavirus pandemic crisis. On the example of mentioned crisis and taking into account the works considered in our slides, we used the multifractal specific heat indicator as a precursor indicator of crisis phenomena. And we presented that actually it's possible to identify crash phenomena even in advance. So we can see that before or exactly at the moment of crash, we observe the increase of multifractality, the increase of correlations in the system. And this indicator can be used for different models, for machine learning models, for deep learning models, as the basic feature that can help to make your predictions more accurate. So that's our contacts. If there will be any additional questions in further, thank you for your attention, and I would be glad to answer your current questions.
Thank you so much. I hope Tusif can speak because, as I know, he had some technical problems. to see if you heard us, please you can continue.
Oh, I just want to understand I believe this presentation was somehow more on the technical side, actually. I belong to the business and management sciences fraternity or field, wherein we conduct researches for business and economics, actually. So I would like to request Mr. Andre, to kindly explain the objectives of this research and where we can actually utilize this research output.
Yetusis, thank you for your question. A really important question. So, in general, what we presented here, uh, indicator of crash phenomena or indicator precursor of crash phenomena. We presented that actually crashes from the perspective of theory of multifractals. They are presented to be fat-tailed. They are presented to be very correlated. And the idea here is that it's possible to use this indicator or indicator precursor for your probably trading strategies, or probably even for your machine or deep learning models. So on the basis of this heat capacity indicator,
Okay.
or this um, general multifractal heat capacity in this one-dimensional representation, it's possible to use it as an indicator or indicator precursor of crash phenomena. And on the basis of this indicator, you can try to construct automated trading strategy that will decide where the points, the stages for the most how it's said. So where actually to buy some active, and the most optimal point where to sell it.
Okay. Good.
But again, another option is to use these specific indicators as features for your statistical model. So you can put it to the input of probably some Varima model, or probably some machine learning model like random forest, probably to your neural network, whatever you want, for some multi-dimensional machine or deep learning model.
Okay. Thank you very much for clarifying the objectives in detail.
Thank you for your question.
Uh, can I ask a question?
Yeah, sure, please.
Thank you. Thank you very much for interesting presentation and very mathematical and very reliable results. And I would like to ask you such a question. Taking into account your experimental part of your research, did you consider which time in average, for example, between calculated precursors and market crashes?
Uh, yeah, Vitaly, thank you for your question. Also, very important question. Uh, there is a little problem with this approach. Actually, with the stock market index, the stock market in general, each crash has its own like uh, how is to say. So each crash has its own complexity and its own nature. So different circumstances, uh, so there is different circumstances behind each of these crash, and that is the reason why each of these crash has different periods of I would say identification. Some crashes we see only at the stage of appearance. Some crashes we see beforehand. So some crashes works as precursor indicators. Some indicators works as only indicators. So some of them, as an example for this COVID pandemic, we can see that there is precursor signal, and even we can see precursor signal for the crash of 2008, but we don't see precursor signal as an example for 1929 because there was another circumstances that led to this crash. So that's the reason why I am saying that it's much better to give it to try to construct some automated algorithmic strategy, to give it to some robot that will decide for you where should you to some robot that will give you the best decision for buying and selling, or give it to machine or deep learning model as statistical features to make your forecasting more reliable, more accurate. It's very difficult by yourself to define where you should buy or where you should sell, actually.
Thank you for your extension answer. And I have one more question. You demonstrated several precursors, and taking into account this fact, I would like to ask you about the more precursors, the more probability of market crashes, or precursor guarantee market crashes. So give our 100% possibility what market crashes will appear.
Yeah, thank you for your question. Actually, yeah, it doesn't guarantee that there is going to be crash because of rising or falling of precursor. What it guarantees you is that the stock market appear to be more self-organized, more correlated. Does it mean that self-organizedness of the market lead to some crash? Not necessary. But it can guarantee you that it becomes more trending, it becomes more correlated. And trying to put more indicators, you can actually then try to identify if they're going to be crash or not. So again, it's more suitable in this case actually to use some forecasting model to decide if they're going to be crash or not. But what this feature tells you is that market becomes more self-organized, market becomes more correlated. Market expresses more correlation in its small fluctuations and large fluctuations, and actually different statistical Q moments. They give you like information on which fluctuations, small or large, are presented to be more correlated. And on its basis, you already decide what is going to be next.
Thank you.
I hope I understand your question correctly.
Yes, of course. Thank you. I have no question. Thanks.
Thanks a lot.
Thank you very much from my side too for answering the questions in details. Thank you very much, Andrew.
Thank you very much. So I can stop my presentation, yeah? Or if there are some additional questions from audience? Okay, I don't see any questions, so probably I will stop my presentation. Thanks a lot for your attention and for your questions.
Thank you very much. I believe if any of any of the audience or participants have any other question regarding this presentation or this session, we may proceed with the answers. Or
Thank you so much, dear Tusi, for all our presentations were demonstrated for us, and thank you for your time. Thank you for your attention on each stage of our PhD symposium, from program committee members to chairs of session. It's very important for us, and it's very important for our PhD students who can take into account all notes to enhance their future research and to defense their research in nearest future. Thank you so much for your participation, and I would like to thank all participants of PhD Symposium and to invite you to take part on our next event. I'm very glad to see Andrei Viktorovich, and I'm very appreciate for your participation on all our main events, and I hope you can take part in our future initiatives under umbrella of Victory. Thank you so much.
Thank you
Thank
very
you so
much.
much, Vitaly. Thank you so much.
Thank you so much.
Thank you so much.